All right, everyone. Wanted to thank you for coming today to webinar Strategic Finance Planning with Modeloptic. My name is Matthew Vale. I lead the marketing efforts here at DeMar Consulting Group. And again, I just wanted to thank you for coming to join us today for part one of our webinar series. Today, you're going to learn about the framework on how to create a comprehensive financial model that supports budgeting. I want to introduce our speakers here. First, Eric DeMar. He's the founder and CEO of DeMar Consulting Group. Eric has provided comprehensive accounting services, financial management, and strategic consulting to diverse ranges of clients throughout his career and consistently optimized financial processes and improve profitability. Joining Eric is Trevor Mullen. He's co-founder of Modeloptic. Trevor brings over a decade of corporate finance expertise, has served as a financial leader and CFO for various publicly traded and privately held companies. He leads all go-to marketing activities, or market activities, I should say, plays a key role in product development and driving growth and innovation at Modeloptic. So with that, I will hand it over to Eric and Trevor, and I'll be back with you at the end. Enjoy the webinar.
All right. Thank you, Matthew. So today we'll begin by discussing the concept of strategic finance, what it means, how it differs from traditional finance. After that, we'll move into a live demonstration of the Modeloptic platform to give you a hands-on view of how it functions. And we will then conclude with a Q&A session where we'll address any questions that the audience may have. So before we dive in a little bit, I wanted to give a background on DeMar Consulting Group. We offer full service finance solutions that really go beyond traditional CPA firms. We operate through tax advisory as well as finance operations, data analytics, and assurance services. Many small to medium-sized businesses work with CPA firms that primarily focus on compliance and filing tax returns, where we fill the gap by providing more of a comprehensive financial management services, offering both a high-performing tax team and a dedicated finance team that really functions more like an internal finance department at a larger corporation. We call this our Office of Finance as a Service. So there are three distinctions I make between traditional and strategic finance that I want to highlight. First, focus in traditional finance being on the past. It's primarily concerned with ensuring that historical financial data is accurate, transactions are recorded correctly, compliance is met. Traditional finance makes sure that everything that's already happened in the business is properly documented, whereas strategic finance not only does that, but the focus shifts to the future. It's about forecasting what's coming next, making predictions, shaping strategies that really plan for growth. Traditional finance tends to be operational and reactive, once again, focused on processing transactions, closing the books, generating reports based off what's already occurred. Strategic finance, the approach, is actively involved in the decision-making process, using tools like financial modeling, scenario analysis, forecasting to influence long-term business strategy. It also collaborates across departments to drive the business forward. Finally, we have outcome, which refers to what each type of finance ultimately delivers. Once again, the traditional finance, the outcome being reporting compliance of the past. So this could mean accurate financial statements, tax filings, meeting regulatory reporting obligations. These are necessary, but they don't offer much in terms of guiding future business actions. Whereas strategic finance, we're focused on using analysis and forecasting to inform decisions about growth, resource allocation, risk management. As we move on to how to accomplish strategic finance, a key tool in this is financial modeling. So modeling is really the process that allows us to take a data-driven approach. We've broken down this process into 4 steps, where first we identify the key drivers that impact the business, often referred to as KPIs or key performance indicators, like conversion rates, equipment utilization, or other industry specific indicators that are considered to ensure that the model reflects key variables that influence performance. Next, we design the model that integrates these drivers into the company's financial statements, where we adopt what's known as a driver-based modeling approach. So unlike traditional financial modeling, where we rely on fixed assumptions or maybe a percentage growth assumption, driver-based models link real business activities to financial outcomes. So an example of this would be in a retail business where customer foot traffic or online conversion rates can be the drivers tied to sales forecasts. Or in a service-based company, employee utilization rates might drive revenue projections. The third step of building out the model is collecting historical data, inputting this information into the model, and using this to impact future performance. So this is where Modeloptic really shines. Shortly, Trevor will walk you through how this tool makes the modeling process more efficient and insightful. The last step is validation. So we work directly with the business to verify that the assumptions of the model make sense. Might run multiple scenarios, base case, a best case, a worst case, to allow us to create various iterations and adapt. And finally, I'd like to say that it's important to understand that modeling is not just a one-time event. It's an ongoing, dynamic process that requires regular, recurring attention. So as the business evolves, you want to factor those changes into your model. Well, at this point, I will hand it over to Trevor, who will give you a deeper look into the Modeloptic tool and its capabilities. Trevor, over to you.
Awesome. Thank you, Eric. Let me just get this screen share going. All right. That should be live. Is it visible?
Yes.
Perfect. So thank you, Eric, and welcome everybody. I'm thrilled to present to you a little bit more about Modeloptic and go a little bit deeper into everything that Eric just kind of laid out, kind of the process of building a model and how it can be beneficial to you and your company. Now I know we have a diverse audience here with varying levels of expertise and familiarity with the financial modeling process. Some of you may have models and processes in place, others may not. But either way, at the end of the session, my hope is that these insights will give you some takeaways that you can bring back to your modeling processes, whether you're starting from scratch or you already have some established. But talking about just going a little deeper to what Eric was saying, the status quo, kind of what a lot of small businesses kind of do on an ongoing basis is, some unfortunately really just focus on the accounting detail and focus on a backwards looking view as they try to manage in the future. And although your history is an important piece in that mix, it cannot be the only means in which you do manage your future. Other businesses, maybe they do a little bit of lightweight projections, maybe they've got an income statement or a revenue build. But oftentimes these fall short as you move to the balance sheet or the cash flow. Thus, you don't get a good, clear picture of your cash position into the future. And as we know, cash is the lifeblood of all businesses. The last thing here too, when we do speak with companies that do a little bit of modeling here and there, we often find that their models are very outdated, often just collecting dust after they put it together. And the reason that they might be speaking to us or why we're engaging is the fact that they have a fire drill and they need an updated model for some other need. So I won't go into all the detail kind of Eric laid out, but just to take that one step further, why robust forward-looking projections are so important. It's simple. Your business, its leaders, you need to have a plan and know where you're going. You've got to know where you want to go and ultimately how you're going to get there. And so that's what creating a set of projections and creating budgets and forecasts will do and afford your business. But ultimately, here's the great news. And so what you're seeing on screen, this is Modeloptic, and this is our, our financial reporting and projection software that we've created. And the beauty of this is that with the rise of these modern FP&A tools, such as Modeloptic, they will integrate with your accounting system and they will help manage all of your reporting and projection needs into the future, thus really taking away any sort of excuse that you may have had as to why you couldn't find the time to better manage this financial side of your business. And the quick aside is that I too, right, I'm a founder myself. I know how busy we can get managing sales efforts or marketing or operations, but with a tool like this, there really is no excuse. You can be accurate and efficient with your processes. And also, not least, even if you're not a financial expert, you don't have a background in financial modeling and that sort of thing, these purpose-built tools have guide rails in place that can help keep you on track and ensure that you're moving in the right direction. But the purpose of this portion of the call is to kind of take a deeper look into what the process is to building a model. So to that end, I think we all know a financial model. It's going to be comprising the three statements. That's going to be your income statement, your balance sheet, and statement of cash flows. Excuse me. All these statements, they're going to be interconnected, creating one cohesive, comprehensive view of your financial position. And in order to do this, in order to put these together, you're going to need a few data sets in hand. And so the first and key one, assuming that it exists, that your company is in business, in market, you have an accounting system stood up, will be that accounting detail. That's going to be a huge portion of this model and the foundation that you will build off of. Beyond that, you should try to get your hands on other operational metrics or other data sets. Some examples of these: personnel information. So you surely have a roster of your existing employees, maybe some hiring plans. Other operational metrics such as number of leads, customer counts, numbers of subscribers. That's kind of revenue related, but you get the picture. Those sorts of things help you build out that driver-based logic and backfill some historical metrics to then guide you into the future. Now, with all this in hand, if you have those data points available to you, now you can start with the model build. And so at a high level, you really got two different approaches here, as I like to see it, and they go hand in hand. The first is going to be your top-down view. And this is great for you to establish high-level targets, depending on where you've been in the past and where your business goals are, where you want to go in the future. Also, maybe the market opportunities that you're seeing. What are the high-level revenue targets? What are the high-level margins that you're trying to achieve? Maybe that's, for example, 10% growth into next year or 20% growth, or based on your industry and team, you think you can achieve this. Once you've roughed out those targets, that's when you're going to transition into the bottom-up build. And this is the really critical piece. So what this involves is creating detailed driver-based logic. And through this process, you're going to start to understand what's required to achieve those high-level targets. And it's going to validate, can you achieve them? So, some of these examples of the thought-provoking nature of this process are going to be, do you have the right level of resources in your staff? Or, can your sales team reasonably hit these targets based on where they've been and what you're asking them to achieve? Or maybe even another key one is you've got a customer success team that only can support X amount of number of clients. And based on the staff that you're projecting and the revenue that you're intending to grow to, there's a disconnect. So this process really starts to illuminate that ground up build as you're trying to get to that target that you set out at the beginning. It either kind of confirms or denies whether that's possible, or you need to go back to the drawing board and change course. One other key point to this that often I think gets overlooked is the collaboration piece. And this is kind of a management opportunity, honestly. So by involving key stakeholders, whether that's sales team members, marketing team members, you're not only going to get some of the best insights from those people because they're closest to the information, but it also encourages them to buy into these goals that you're trying to set out. There are studies that have shown, if you are, people are much more committed to achieving a goal if they're involved in the process of creating them versus, really just being dictated to after the fact, telling them what is expected of them. So that's another kind of key piece of this whole process that often gets overlooked. But with all that said, now we can start to talk a little bit more about the actual implementation and get a closer look to of Modeloptic, which I have on screen. So, I often, when I think of building a model, I break it down to two phases. There's the first phase, which is the historical side of things, and then there's the second phase, which is the projection side of things. So speaking to the first phase, the historical side, your first item to address is going to be defining the chart of accounts. And so, as we all know, you've got your accounting system, the GL. The purpose of that is to systematically record transactions for accounting purposes. When you're building a model, our purposes are financial reporting and projections. So you can deviate from that detailed, granular GL level structure, and you can create a new, cleaner, more concise account structure for modeling and reporting purposes. And so that's step one. And as you can see here, we've got a really clean chart of accounts. This isn't super granular. It doesn't have all of the GLs. And just maybe to give you an example of where you would do some of this cleaning is maybe you have some legacy accounts from years back and that no longer have activity. You don't need to create a distinct line for that. You could just roll it up into maybe a miscellaneous expense because the only activity is going to be years into the past. So once you have defined your chart of accounts, then the next step is mapping the GL account level structure to this new, cleaner model structure. Just to kind of give you a visual of what that can look like, this is our approach in our system. Under this header, you can see what the QuickBooks chart of accounts is, which is very detailed. And then there's mapping targets. So these are going to be the cleaner chart of accounts that we've created in our system. We used to do the same process in our Excel-based world. It's a very similar conceptual workflow. But as you can see right here, in this case, this is merging the two. This is merging your accounting detail and our Modeloptic chart of accounts. That we've got two accounts, one being services legacy. So this is going to be a case where there's not a lot of activity in 2023 or 2024. It's only in 2022. We've rolled that into just one holistic implementation line. So with this process, whether you're doing it in Excel or in Modeloptic, you should then have all the historical financials wired up and mapped into this new chart of accounts. And now you can move on to phase two, which is the projection side of things. So when I start to think about creating the projections, that phase two part of building projections and logic and modeling, it's really honestly just a natural walk top to bottom. So I'll walk through the income statement, starting with revenues and working my way down. And then I'll get to the balance sheet and work my way down. And then naturally the statement of cash flow comes after that. And so, starting with the income statement, starting with top line revenue, that's always going to be, we more often we'll see that revenue is going to be one of the most nuanced pieces of any sort of model that you're building. A common way that you'll approach it, you'll have maybe a sales funnel, in a proper revenue build. You've got a lot of different operational metrics, different top of funnel drivers that start to work its way down, ultimately getting you to your revenue that you're recognizing for future periods. And so what that can look like, I've got an example here in our system where you can see that we have our leads at the top of the funnel. And then we have some assumptions for how these leads are going to convert to new subscribers. Then we've got our active number of subscribers, and I should say this is for just kind of a SaaS demo co, that type of business. We can see how many subscribers we intend to have into the future or expect to have in the future. And then we ultimately translate that into what the revenue that we will be recognizing at the top of the income statement will be. So this is typically a nuanced piece of every model. Generally, there's going to be a lot of driver-based logic, but this is critical as a first step to working through creating projections. So if I take this back to the income statement, you're going to see we in Modeloptic, we've mapped that final revenue recognition from our revenue build to the top line of the income statement, but you would do the same thing in an Excel-based world. From here, natural next section that we'll hit is going to be the cost of goods sold. As I'm sure we all know, cost of goods sold, typically more variable costs. These are going to be related to your revenues and flow naturally in line, more so in relative terms to revenue. And so kind of a common approach here, I've got one example, hosting and services cost for the SaaS business, again, a percentage of revenue, because we expect as the data increases, we're bringing on more customers, we're getting more data, there's going to be additional hosting and server costs. So we've got a percentage assumption, and this will grow into the future. So many different ways that you can approach COGS depending on the market or the industry that you're in. But this is one way that you'll naturally then address the COGS section. Then flowing down to OpEx, we know that OpEx, these are going to be more fixed costs. They're also going to comprise your salaries and wages more often than not, at least for kind of the overhead teams, G&A, that sort of thing. So in that case, we often typically will build a roster that houses kind of all of the employee costs, their annual salaries, some of the peripheral benefits and that sort of thing. Typically looks like this. If you were in an Excel-based world, but Modeloptic, we've brought kind of that same sort of dynamic and template to our system. So this is where you can feed in a lot of those expense projections into your model. And then taking that one step further, just other kind of OpEx accounts. Some are going to be kind of less variable, kind of fixed in relative terms, such as an other expense line where maybe you just want to use trailing averages. So in this case, we're just looking at history, and that's going to be the best indicator to flesh out our projections for this case. Where it doesn't have to be just flat fixed numbers for OpEx. They're not so fixed that they never change in the future. It's just they change in relative terms to COGS less. They're less directly correlated to revenue. But in this case, maybe something like computer expenses or actually software expenses, based on the number of employees, as these grow into the future, you want to multiply some sort of average cost per employee to grow these OpEx expenses in your projection sets, your forecasts, that sort of thing. So there's a ton that we could cover here. I only just scratched the surface right there. I'd love to give more detail, but it would have to be for another time. So, in the interest of moving on, I know we're getting later into this webinar. Next, we want to hit the balance sheet. So once you have the income statement built, then you need to address where on the balance sheet are there going to be material impacts to our cash position. That's ultimately what you're trying to figure out. And so one of the easiest ones to call out that naturally kind of follows as you move from the income statement to the balance sheet is how you translate your sales to cash. So if you're in a consulting business, it's more likely that you're going to render services, you're going to provide services, and then you're going to invoice for it after the month is over, and then you'll collect maybe net 30 after that. So accounts receivable would be something that you would need to dial in to better understand when those cash flows are going to hit, which aren't directly correlated with when you recognize the revenue. Conversely, the other side of this could be an instance where, in a subscription-based business that you have deferred revenue because people are paying upfront annual contracts. You're collecting that payment upfront, but you want to recognize the revenue over the duration of that contract's life. Maybe it's an annual contract. So, if I expand this, you can see deferred revenue is increasing by these annual subscriptions that we expected to see come through in September, but then it's being reduced. The overall balance is being reduced by the revenue that we're recognizing. This is at 1/12 that we saw on the revenue build. But ultimately, if I just segue really quickly, jumping down to the statement of cash flows, you can see the net impact of the additions and the recognition is still a net increase to our deferred revenue. A few other places that you'll want to start dialing in. Again, the whole concept is oftentimes people will forecast their income statement, but their models really get pretty lightweight when they get to the balance sheet. Thus, they don't have a good understanding of cash. A few other ones that you'll probably want to dial in on the balance sheet. PP&E, if you're a capital intensive business and you require a lot of CapEx, this is where you would need to spend some time putting in some assumptions for additional capital expenditures, also the depreciation side of it. Another area could be your accounts payable, different expenses that you incur over time and what your different payment terms with those vendors are, to better understand what your cash flows will be. And then lastly, different financing options. So whether it's debt or maybe equity, that sort of thing, when you expect to raise, what sort of interest expenses are being incurred, what repayment terms are embedded. So, these are different areas on the balance sheet where you really should start to tighten up your projections. And this will ultimately give you a really clean understanding of, based on all the assumptions that you put in, what you can expect your cash to be in the future. So with the income statement and the balance sheet defined, we get to the last of the three statements, the statement of cash flows. Kind of just dovetailing back to these modern purpose-built FP&A tools and the benefit. If you're using something like Modeloptic, you don't have to touch this at all. It wires into the income statement and the balance sheet and does everything for you. layering in the inflows and the outflows from operation, investing, and financing, getting you to your net change in cash. So really not much that you need to do here. There is one last kind of area that I would like to point out when you're building a financial model that is really key, and that's going to be your key metrics section. And so, you've put in all this work building out your income statement, your balance sheet, your cash flow. Now you can leverage all that to your benefit to define KPIs or operating metrics that are, important to keep an eye on and better manage your business into the future. So in this case, we've got our CACs, we've got our LTVs for this, again, SaaS Demo Co. But for your business or your industry, the sky's the limit. I would recommend, if you're building on a model in Excel or in Modeloptic, really leverage everything else that you've built above in the 3 statements to codify some of these different KPIs that maybe are indicators of opportunities or risks into the future. But I know we're getting towards time. I guess maybe one of the last things I do want to say, all of this is iterative. So, what we don't want is that you let perfect be the enemy of good. It's expected that this will evolve over time. So one thing, for instance, to give you kind of an example of how that could happen is, let's say that we just, in the SaaS instance, we're just forecasting total customers that they're going to come in. We're not worried about different plans, premium, standard, that sort of thing. We're just looking at the total number of customers that we're forecasting. Well, maybe down the road, as we get better data, then we could transition to something that's a little bit more granular. So I just transitioned to this other more detailed Demo Co, where you can see we've got software subscriptions broken out by standard, advanced, and premium plans. So these different dynamics can give you a better sense of, all right, well, if our advanced grows faster than our standard, that's actually probably going to be more of a windfall. Or if you're growing your customer base, hand over fist, but they're all the standard plan, which are very low margin, that's going to be a different story as well into the future. So this is where you can continue to iterate into the future. I guess one other thing that I did want to mention was, once you've built out your model, your income statement, your balance sheet, cash flow, you should sort of cycle back through and revise assumptions, because maybe with the original assumptions that you put in, you're seeing that your gross margins, they're so distorted, they're way higher than you've ever achieved historically, or they're way higher than industry targets, and so you need to revisit. Something must be amiss here. Another area that this often plays out as we're working with our customers is cash. With the assumptions that we've put in, do we see that there's a deficit in the future? And does this mean that either we need to cut expenses, do something different with our resource planning, or maybe do a capital raise? So this is where you really can start to get the benefit. Once you put this together, there's a lot of benefit that can be gleaned from this. And maybe that's quickly just a good segue to speak about the next session that we're going to have. That's going to be basically, we've got our model built. And now what do we want to do with it? How can we leverage this to better manage our business and gain better insights into our company, where we are and where we're going? And so that's what we'll talk about in the next session. But I know we're at time. One last kind of plug that I wanted to put in. We've only barely scratched the surface of Modeloptic. If you're interested and you want to learn more about how we go about leveraging this to better serve our customers, we'd be more than happy to schedule a call and go through a more proper detailed breakdown and demo of how this all works. We have a link which we'll put in the chat. It looks like it just went in. That'll bring you to our scheduling page, and you can schedule a call with both Modeloptic and DCG, and we're happy to explore the conversations from there. But with that said, I will pass it back to you, Matthew. I know we're over time, so apologies, but yeah, happy to pass it back.
Yeah, thank you so much, Eric and Trevor, for that. Lots of really good stuff in there. And thank you all. I know that we are a couple minutes over time, but I did want to ask a couple questions to Trevor, if you all have just a couple more minutes. And I wanted to ask Trevor, what sorts of clients is Modeloptic best suited to serve?
Yes, happy to share about that. And I know we haven't gone into a lot of detail into Modeloptic and our approach, but as a quick overview, it's very Excel-like, and that's going to allow a ton of flexibility in the way that you build your logic. So we're not, specific to one industry. It's not that these can only build a SaaS model, although that's what our Demo Co was. We're actually industry agnostic. So regardless of what industry you're in, suffice it to say that Modeloptic could be a great tool for you. As far as kind of, the size and maturity of these companies. We typically see companies with 5 to maybe 500 employees, that sort of range. If you're less than that, maybe you're so early stage that Excel might still be a good tool for you. If you're over that, maybe you need to move to more of the enterprise tools, that sort of thing. But we're happy to again explore any conversations, and I think you would find that regardless of your industry or your complexities, that Modeloptic could be a great tool for you.
Awesome. Yeah, so I guess just jumping off of that, another question would be like, how long does a typical implementation take for these businesses?
Yes. I can give some general guidance to that, but obviously it's a little bit of a case by case basis. But more often than not, let's say that you already have a model built in an Excel-based world, and it's really just a transposition. We can get that stood up in our system in less than 10 hours. I mean, it could be as short as a day, 2 days max to get that built in Modeloptic. If it's more of a working session, and maybe we also find a little bit of difficulty getting time on each other's schedules, that could lead to a week, 2 weeks max. But this isn't going to be months long implementations getting stood up in the system by any means. Also, if you have a more complex revenue build or model, that sort of thing, or you haven't really sketched this out ever before, maybe it's going to take a little more than those 10 hours. But still, we're very efficient, both us and DCG, in getting these things stood up. And you'd be surprised how quickly you can start to see the benefits.
Awesome. Awesome. All right. Yeah, if there's anything else, any questions that anybody has, I know we're over time. Let's just be mindful of everybody's time, actually. I'll go ahead and put in the chat too, for part 2, there's a sign up. And make sure that you use that link and register for part 2. It's going to take place 1 week from today. It's going to be at the same time. Right there on your screen, you're going to see a link to learn more with Modeloptic, schedule some time with Trevor and his team and us here at DCG. And thank you guys so much for coming out today and spending your morning or afternoon with us. And we hope that you found it insightful.